All right, welcome to The Explainer. Today we're going to talk about a financial strategy that's built to tackle two of the biggest fears people have about retirement. Huge market drops and, of course, taxes. We're going to break down how it uses two different tools, an indexed IRA and an indexed universal life policy, to basically play both offense and defense with your savings. So let's just start with the question that's probably on your mind. Are you worried about how a sudden market crash or, what taxes might look like in the future could just wreck the money you're working so hard to save up? This is a huge anxiety for so many people, and it's the exact problem this particular strategy aims to solve. So what's the promise here? Well, the claims are pretty big. We're talking about growth without the constant stress of market crashes, leaving a legacy for your family without raiding your own retirement funds, and being able to get to your money with some serious tax advantages. These are bold promises for sure. So let's dig in and see how it's all supposed to work. So how does it do all that? Well, the answer isn't some single magic bullet product. It's all about how two very different financial tools work together. Let's meet the two key players in this strategy. Okay, so the strategy basically splits your money into two different buckets. In one corner, you've got the indexed IRA. Think of this as your growth engine. Its main job is to build up savings for you to use when you retire. And in the other corner, you have the Indexed Universal Life Policy, or IUL. That's your legacy engine. Its main job is to provide a death benefit for your heirs, but it also builds its own separate pile of cash value. So one account is for your future, the other is for your family's. All right, so we've met the players. Now let's get into the nitty-gritty, because this is where it all starts to click. How do these two things actually work? First up, the indexed IRA. Now, it's super important to get this right. We're often talking about a type of insurance product called a fixed index annuity that's held inside an IRA structure. The key phrase here is that your growth is tied to a market index like the S&P 500, but your money isn't actually in the stock market. That's a huge distinction, and it's how it protects you from losses. But how exactly? Well, it all comes down to two simple concepts: floors and caps. The floor is your safety net. It's typically set at 0%. So if the market index completely tanks, you don't lose a penny. But, and this is the trade-off, there's a cap. So in this example, if the market has an awesome year and goes up 12%, your interest might be capped at, say, 8%. You're basically trading some of the highest highs to completely get rid of the lowest lows. Okay, that's part one. Now for the other half of the strategy, the IUL. This is a type of permanent life insurance. So yeah, its main job is to pay out a death benefit. But, and this is a big but, it also has a cash value account inside it that grows in a very similar way, linked to a market index with its own floors and caps. It's a real hybrid, combining that legacy protection with another way to grow your money.
So you've got all this money growing. How do you actually get your hands on it? This is where having two parts really starts to shine. From the IRA, you take a withdrawal. It's pretty straightforward, but it's generally going to be taxed as income. The IUL, though, gives you a totally different path. You can take a loan against your cash value. These loans are usually tax-free, and you don't even have to pay them back. If you don't, the loan amount just gets taken out of the death benefit later on. It's two different ways to get cash for two different needs.
Okay, theory is great, but what does this actually look like with some numbers? Let's walk through the sample scenario from the source material. It'll make this way more tangible. So let's imagine you're putting away $1,200 a month. Instead of it all going into one pot, the strategy splits it. The lion's share, about $720 or 60%, goes into the indexed IRA. The goal there is to really juice your personal retirement fund. The other $480, that's 40%, gets funneled into the IUL to build up that legacy and cash value piece. So what happens to that IRA money? Well, with that steady $720 a month compounding over the years, with those market-linked gains and that downside protection we talked about, the example here shows it growing to over $500,000 by the time you're 60. That's your primary fund right there for your own retirement. But wait. That's only half the story. While the IRA was doing its thing, remember that other chunk of money, the $480 a month going into the IUL? Well, that was building its own separate pool of money, growing to over $300,000 in cash value. And here's the kicker. This is the money you can potentially borrow from, tax-free. And finally, the whole reason you have the life insurance in the first place. On top of your retirement account and that accessible cash value, the IUL in this example is set up to provide a $1 million death benefit for your heirs, a benefit that is generally passed on income tax-free. See how it all fits together? You've got money for you, a flexible pool of cash, and a legacy for them.
Now, a strategy like this isn't something you just set and forget. It's powerful, but it needs attention. So let's shift gears and talk about the long game, how you actually manage this thing over the years. And look, managing it isn't rocket science. It's really just a simple 3-step cycle you repeat. First, you set up an annual check-in to see how both accounts are performing. Step 2, you take a look at your own life. Have your goals changed? Do you need something different now? And finally, you work with your advisor to maybe tweak the funding a little bit if you need to. It's all about making sure the plan keeps up with your life.
At the end of the day, this strategy isn't about some abstract idea. It's based on tested planning principles. The entire goal is to find that sweet spot, a balance between powerful compound growth for you during your lifetime and a smart, efficient wealth transfer for your family after you're gone. And this all brings us to one last big question to think about. We talk all the time about diversifying our investments, stocks, bonds, real estate, the whole shebang. But what if the most overlooked key to a truly secure retirement isn't just diversifying your investments, but diversifying your tax strategy? Having your money in different kinds of buckets with different tax rules might just give you the flexibility you need for a very uncertain future. Now that's a powerful idea.